Hi guys, it's Patrick Reed from the Adams Principal. I'm at the offices of BluFX. Basically, both of us are your one-stop shop to all your trading needs. Myself would do a lot of education and mentorship, and if you want funding and dip your toe in the FX world, but also gold now, pop yourself on the BluFX. They're great guys, and I've been doing a lot of webinars for them recently. But today I'm very excited because today the webinar is called Data is King. So without further ado, I just want to tell you a little bit about myself, what my qualifications are, what my background is. I started out as a futures trader, so data or day trading, which is basically data, that's what we did, right? And I did that for a couple of years for tower trading, one of the biggest futures prop desks in Europe, about 160 guys under them. I then moved to spot, but today I'm going to kind of give you all of the golden rules of what to do and what not to do when there's data coming out. So without further ado, I'm going to kick off with, before we go into the 4 golden rules, I just want to tell you something about that you've got to really realise. Trading data is very hard, okay? It's very difficult, but it's not impossible, okay? You've got to realise what you're up against. You're up against algos, who are basically ex-NASA coders, who they're quicker than the nanosecond. Okay, HFT are in on that game, Citadel, Virtue, D Shore, they're in on that game, so they are going to be quicker than you. However, you can still trade it, and I'll show you how, and I'll show you why it can still be very profitable. The first thing I want to tell you is all kinds of data fall into 2 categories, okay? Hard data and soft data. So hard data is basically data released by ONS, government bureaus in the States, real proper solid data. And the data that falls into hard data is non-farm payroll, CPI, PCE, wages, GDP, of course, retail sales, home sales, and things like this. Okay, those bits of hard data are the most important bits of data on your radar. You need to be across all of those. The daddy's non-farm payrolls, obviously, but the others are really important as well. So the soft data are generally surveys, like manager surveys. So basically various agencies phone up lots and lots of surveys, and they're given these questionnaires, and it sounds kind of slightly arcane, but they are still very important. And the soft data, things like ISM in the States, ISM, PMI, ZEW, and things like this. So these are less important, but they're still important, and obviously you have to put it in context with market positioning and sentiment, Last week, right, so just a quick time check, it's the 26th of April, it's around 4 p.m. Last week we had, and the week before we had cable, Great British Pound Dollar, we'll call it cable, rallying. Really main reason was talk of an M&A acquisition. We had 2 bum bits of data, wages 0.2 off, CPI 0.2 off. Now we had Carney on the Friday, it flattened the pancake. So all the steam got taken out of cable, and now we're off 3-4 big figures. Yeah. So all of this is important going into the specifics of data. All right. So just bear that in mind. So that's a little bit about the types of data and a little bit about me. Next, I'm going to be talking about the 4 golden rules of how to trade data when data is king. Rule number one, okay, this is going to take time, but you have to do it, right? This is essential. If you forget everything, remember this: record your moves on historical data. All right. If you look at my Excel spreadsheet, before I had an Excel spreadsheet and record all the moves, I had diaries. I filled up diaries, years and years of diaries. If you told me non-farm payroll was coming out, I could tell you roughly what kind of moves would happen on the G5 pairs. Okay, I could tell you if it was expecting this and it came in at that, I could probably tell you roughly what the moves would be. And I'm not bigging myself up, but it would be pretty accurate. And the reason of that is I've recorded the moves of non-farm payroll for a very long time. Okay, I really encourage it. Non-farm payroll is a kind of a beast on itself because of the additional sub bit of data called wages. But still, you still should always record your moves and start doing it today. Okay, it's really important, and do it. Match the data with the personalities. You know, if it's retail sales, dollar yen's probably going to get a bigger move. If it's CPI, probably euro dollar. You know, non-farm payroll, euro dollar, just for me anyway. Obviously there's an added risk on, risk off with dollar yen, but the moment you do this, you can then look back on all of your months, because obviously most of the bits of data, well, pretty much all of them are every month. Excuse me. I guarantee if you go by your previous months, you will get a pretty good idea of the moves. Okay, so that's number one. Okay, number two, get the sentiment and the ranges. Okay, and you can do this by signing up to Live Squawk or ITC. Those are the two major players on the scene. Sorry, that's just a little update. But you can get a free trial, probably of a couple of weeks, and when you get the free trial, they'll send you data sets of Bloomberg ranges. Okay, and what that is the expectation, the low and the high. So what I've done, dropped off with the guys at BluFX, is that I've given you a template of an example of non-farm payroll, and you've got low and high. If the data comes out at the actual that's different to the expectation, that's one thing. If it falls outside of the ranges, that's quite another, because you get a massive move. Yeah. So sometimes when it's 30,000 difference, you're not going to get that much of a move because the rate is within the ranges. These ranges are very important. Okay. If they come outside of the ranges, the market is not expecting it. It's anti-sentiment. So you will get an extended move. All right. So just bear that in mind, and obviously with your prior knowledge, just make sure you've got the type of data, the personality on the match the data to the personality of the pair, and you've got this kind of range from low to high. So that's the second rule. Okay. So the third rule is this: plan your trade and trade your plan. I say this all the time, I'm going to say it again. You've got your plan, you've got your ranges, you picked your pair, you've got your expectation, you've got hopefully your actual when it actually comes out. What are you going to do beforehand? Okay. I think you should just really take some time in understanding. Do you fade it? You know, if like the dollar's really strong this week, if let's just say non-farm came out today and it was really weak, do you get a cheap dollar? Yeah, because you know the trend is up. You know the dollar index is going up. It's probably going to be breaking 91.50, 92s. So, or if it's you know, if we got a really strong dollar in the week and it came really strong, do you go with it, or do you wait for a small retrace and then hit it again? Because you know, you might get a second bite of the cherry. Yeah. So these are some of the things I really encourage you to think about. And you know, just as a final thing on the rules is that really pick your pair. I have to stress this: pick your pair with the personality. Sometimes with non-farm, I actually don't really trade non-farm that much nowadays. But what I do personally is how I trade non-farm. I only do euro dollar, and I start small, like a couple of 100,000, or like 2 lots or whatever. If you're doing futures, I only trade it if it's out of the range on Bloomberg, right? And if it's way out of the range, I look at wages. Okay, if wages goes the same way, then I would hit it at market, small, and then add to any retracement. And I'd only look for 50 ticks, because unless it's, you know, expectation 256, it comes in 300, great. If it comes in at 400 and wages is really, really good, it's like 0.2 higher year on year, hit it with all you got. But don't look for more than, you know, 60, 70 ticks. Depends on how much it's moved on the algos, first of all. If you look in your diary, as I was saying before, in your previous notes, and the average true range is 120 ticks on the day, 22 average, 22 day average, and non-farm moves 100 ticks, then you just bear that in mind. You know, how much more can it go? Well, I've seen non-farm go 3 big figures, not recently, but it has done, you know, 4 or 5 years ago. That's not really going to happen today unless it's massive, like 600 or 500, which, you know, to be fair, it's not really going to happen. So I hope that's helpful. Those are my 4 kind of golden rules. I did veer off a bit off the reservation, but you really can get a sense of you know, where it all starts. Don't worry about anything else. Realize it's very difficult to trade. Just, you know, if I'm gonna wrap on this little webinar, remember these things, you know. And finally, conclusions are this: technicals work, the levels work, but pick your wise. I don't know if you caught my wonky webinar last time, but this is the same. Pick your spots, you know. If euro dollar's at 121.09, like it is say now, and you've got non-farm payroll, you don't want, you know, if that's near a level like 121.65, it's a bit of a level, you don't want to be fading that. You don't want to be bouncing off that level. It's going to go right through it if it's really weak. Yeah, so just bear that in mind. So I would stick to the levels, but at least 100 ticks away. Cut your size. Just remember, you can always add. Just think about your risk. You know, at 30 ticks, you know, it's going to be very thin. Don't go more than 30 ticks. 20 if possible, but it will be thin. It'll be quite jumpy, bit of a jumpy cat. So really cut your size. Leave your risk around 20, 30 ticks. That's what I would do anyway. And finally, remember this. Those of you who have seen my webinars before know that risk is really your best friend, my best friend. If you can understand risk, you can define it. And if you can define it, you're not scared of it. And if you're not scared of it, you can trade without fear. And there's nothing to be fearful of. You set your own risk, right? You set your own risk by choosing where to trade, but you define your risk by putting your stop in. Okay. Now, when there's a big data release coming out, there are added risks that you need to be aware of. 1, liquidity. There are few participants, or fewer. That means markets wang around a lot. And the reason for that is you've got massive institutionals sitting on the sidelines, crunching numbers. They don't want to pile in immediately. They let the algos take it. Then they'll make their moves, because the size they do needs some thought. So they do the 3-month average, they look at wages, they'll put that in context with the 10-year yield, they'll put that into context with what the Fed's doing, you know, and stuff like this. So bear that in mind. The event is a risk, so you know, it could get leaked, it could be an incorrect number. This has happened before, you know, it could get re-released, you know. All of this stuff, there's market risk, which is obviously, you know, flows between buyers and sellers. And finally, positioning. There is a positioning risk as well. Are people wanting to take profit before the figure? Some traders don't even look at non-farm. Big sovereign wealth funds, you know, Norwegians, the Abu Dhabis, you know, a lot of Swiss shops, they don't care about non-farm. It's nothing, it doesn't mean anything to them, because they've got gigantic long positions or short positions. You know, they're short Eurodollar from 140 big figure. Yeah, so bear all this in mind. I hope it was helpful. Trade safe, and you know, contact me on LinkedIn. Hit me up, the Adams Principle. But that's it for now. Thank you very much.